So, Saint Investment Group, where we're at today, we're focusing on fixed income because we have a large group of investors, very sophisticated, typically higher net worth than the average investor typically. So, what we saw was our investors aging quite a bit. Many are in the boomer generation.
Right.
What they were looking for was not 5-year deals, 7-year deals, 10-year deals. What they wanted something was more flexible, but also beating the market as far as returns, whatever market you want to peg that to. So they wanted something that was a 10 to 20-year play that they didn't have to check on monthly. They didn't have to reallocate, rebudget, et cetera. So that's why I like mortgages for the next decade plus on the income side. So if you were to say, Nick, what's your number one bet on the income side of the equation? I'd say without a doubt, I think US single family mortgages will have the most impact on a decade plus and are the most rock solid. As far as somebody looking for more upside potential, absolutely. I think that it's analyzing what the investor needs on their side. If they're growth minded, I think they will see more opportunities in the next 18 months that come available than we've seen in the last decade that are really worth doing.
Welcome back to the podcast. This week, our guest is Nic DeAngelo, and he is the founder and CEO of Saint Investment Group. Welcome, Nic.
Gary, really happy to be here. Great catching up with you beforehand, and I'm excited to talk about some fun stuff today.
There you go. So Nic, you do a lot with commercial real estate. What made you get into commercial real estate?
So I love your community, and I love the topics that you guys cover on this show. And so my heart's in line with kind of the entrepreneurial business owner community. That's where I got into real estate. That's how I got into commercial real estate. Is I was graduating college. I was entering the workforce. I wanted to go into real estate, but it was right in the middle of the Great Recession, really at the beginning, right? Worst possible time to enter the real estate, especially commercial real estate market. So on my side, I had to start a business on the side to support my efforts in real estate because I wasn't making anything. Literally, I was negotiating for jobs to work for free. So I had the benefit to work for a job that was way above my pay grade because I was willing to work for free, but I had to work for free and I also had to eat, which was kind of a complication. So I started a very early business, an ATM business, and was a single owner operator, small business, handyman, internet special, all the stuff. I had to do everything at one time. And for me, real estate was the end goal to hedge that. And what I actually found was real estate was the goal to grow my net worth and grow my income over time. But I actually found more ways to apply real estate to my business that became very lumpy over time. Really high cash flow. Then we would have some dips of expenses, et cetera. Really high cash flow, seasonal dip, summer, people out of town, whatever it was. What I found was investing with real estate with my businesses, as I did multiple over time and ended up selling them over time. I found that real estate subsidized my own cash flow over time. So while the lumps were highs and lows on one side, we had a steady stream of income on the other. So it's really been a lifelong passion, both entrepreneurial endeavors and business ownership, as well as investing. And they've kind of always gone hand in hand on my side.
So you looked at commercial real estate as a great passive income for you because kind of once it's set up, you kind of let it do its thing.
Absolutely. Yeah, that's exactly it. I was looking at it as at some point I was working my butt off in like the 2000 post 2008 era. And, many people, not just me,
Right.
to be clear, most people were treading water or really, really having to work their tails off. So I was working nonstop, 24/7, late hours, early hours, nonstop. Was a tool and an investment that I could put money towards that was not directly linked to time, right? Because I didn't have any more time. I could figure out ways to slowly increase income. I had a tax problem, so I should have been calling guys like Gary earlier, right? So I had a tax problem because I had an income that was growing more than my sophistication was at that time. And then the other was I was directly linking efforts to my income. So I needed to put it somewhere where it had appreciation opportunities and cash flow opportunities and that extra leverage. And me starting young, to be fair, I got good guidance from mentors that gave me this really great advice. And being able to do that helped the net worth side, helped the income side and allowed me to take the foot off the pedal as much on the business and start broadening my scope of different opportunities. So just not being under the gun of the income side, having a little bit less tax drag, using some
Right.
sophistication, those things really took it to the next level when I started understanding those pieces.
Now, a lot of people right now would say that this is a bad time to get into commercial real estate just because a lot of the businesses being online and going virtual and stuff like that. What do you say to that?
I think that's a great assessment with the asterisks of not all commercial real estate. As a spectrum, right? There's a big spectrum in commercial real estate. Me personally, our company, Saint Investment Group, we're not touching the majority of it. Okay. So now more than ever, it's very important what you're looking at, because for a while it was just that high tide raises all ships, right? If the market goes up, most things are doing well. We're just not there. The reality with real estate is it's always two things. It's asset based because there's different drivers for different assets. There's different things that create environments of success or failure, and then location based. So if you were to ask me to drill down on that, what I would say is right now, Gary, I'm not touching office. I'm not even having office discussions.
Okay.
Retail, while there is some regional, players, or there's regional opportunities in retail, that's not where we're at. Multifamily, I think I really like the asset class on a long-term basis, but it was just so overpriced for so many years that buyers and sellers are having whiplash. So for me, today, there's two clear winners that I'd be focusing on in real estate. The first, without question, is single family mortgages in the single family market. Simply because it's so entrenched and so supported and has, it has mortgage rates, huge, the over half of the mortgage rates, I think it's about 60 something percent, are locked in at 3 to 4% rates.
Right.
These are people that, even if they're baby boomers or Gen X, they got 10 to 20 years of ownership expectations ahead. That's pretty rock solid. So betting on a financial, opportunity like mortgages, that's what we're leaning on number one right now in this exact market environment. And then the second, industrial real estate in the US, while we're having issues with China, an increase of costs of goods, an increased export complications, whether it's the Biden administration or the Trump administration, China's a tough relationship for the US right now. And so are many imports. So you're seeing so many opportunities either in the US or just south into Mexico, also a booming economy, where industrial is a good opportunity. So yes, I would agree with any of your audience that says, as a general rule, commercial real estate is a huge concern in many aspects. But between those two, between mortgages in the US, which are just so entrenched with good, fundamentals, and then industrial, which has such a good growth opportunity, that's where I'd say to keep the eye on if someone's looking for investment opportunities right now.
What about business owners that don't own the space that they're currently in? What do you say to them about looking at buying to house themselves and maybe other people with where rates are right now?
So this is the exception to the rule because it's such a good opportunity with SBA financing. It's just, where are you going to get terms and structures like SBA has right now? So that's a fantastic point, Gary. I'm talking more from the investment manager, the asset manager perspective, but we've built and sold 3 different businesses with the Saint Core team. I would say one of our biggest mistakes at different points was not buying the building that we're being in, right? Because I'm not a professional at SBA loans specifically. I think you got to occupy 51%. They got favorable rates. They got favorable terms. I think they'll finance up to 90%. And I mean, Gary, you're the pro at this. There's probably some really good cost segregation and some good advantages to pieces like that. When you combine that into a small business owner, mid-sized business owner strategy, you've reduced tax drag. You've really bought into an asset. You're going to pay rent somewhere. Why not pay yourself? So those opportunities for businesses that can sustain that, for business owners that can sustain that, I think it's such an entrepreneurial move. I think it's so forward thinking. You're investing in your business and you're giving it a good foundation. I mean, I think you hit the nail on the head. That would be the exception to those different asset classes, depending on where that business is at.
If someone has previously invested in commercial real estate and now their spaces are sitting empty and things like that, and they're trying to get out without really losing their shirt. Do you have any recommendations for them?
I have a lot of recommendations and some bad news. The problem is, just to shoot straight, because I've been in highs in business and lows in business. The problem oftentimes is a rock and a hard place situation. I wish that what we were, we have economic trackers at Saint. We put together all kinds of things. Most of everything we just give away for free because we're already doing the work. But what we're seeing consistently, you look at the Federal Reserve, you look at the economic data, you look at things coming out from, whether it's the White House, the Bureau of Labor Statistics, the Federal Reserve itself, all of it looks long term. So it looks like there's certain things that we're going to be balancing for maybe a decade plus. My bet is that we're going to be dealing with inflation for long term. My bet is that rates will be higher as a result of that for long term, which we can scoff at. Oh my gosh, these rates have this huge increase. 5 of the biggest rate hikes, the biggest rate slope up in history, all those things. But the reality, if you look at the backdrop, we're back in the 5 to 6-ish% range, which is right in line with history. So historically, we're kind of in the average, maybe a little bit above, but should settle in the 5 to 6 range. All that to be said, I think that the opportunity for business owners is to evaluate what that new normal looks like. If they're not going to get the returns on a building, let's say in this instance to your question, if they're not getting the returns, if they're looking like they're going to have negative opportunities in their local market, or they're going to have leasing concerns that will be for a longer period of time, I would suggest, and I suggest this even people with successful buildings, that they analyze their returns and they can build in what expectations are. And you can look at big analysis from big companies. You can look at Colliers, CBRE, Baker Tilly. There's companies that give these expectations of market returns. Most are around 5% at the most rosy predictions. So if you're not hitting 5 to 10%, or you're hitting much worse in the scenario that you're saying, Gary, my advice is at some point to cut your losses and invest in a situation where you're getting much higher returns. We see consistently, because we have a fixed income fund. That's our bread and butter. It's mortgage backed. It's what we were talking about earlier. So we pay up to 12%, 14% at our highest range, 12 to 14% at our highest range. So there's people we constantly see, very sophisticated investors. They're saying, I'm only getting 6% on these other investments, and I have to do the job of managing them. If someone's underwater right now, they're not going to get bailed out by rates, is my point. The Federal Reserve, I don't see the rate cuts. No. If you scroll back to 2023, we thought we were going to have 6 rate cuts in 2024. I think we're lucky to see 1. So I would say don't wait on rates to bail you out. That's not a safe bet, in my opinion. And the other is if you're not hitting, 10% or teens, then evaluate what your time is worth, how much effort you're putting in. Maybe you feel comfortable in that position. Maybe it's worth taking a look at some opportunities outside of what you're doing.
Yeah, I think a lot of people, with where rates were, they were so darn low. They're almost looking at it that they think that the rates are going to be temporarily high now. And it's like, no, like you said, I think they're back to kind of the norm because there's no way that our economy could sustain at such low rates. I mean, basically, you could sneeze and people were dropping money at you, for nothing, basically. So I think that's something there. For those people that are getting into the commercial side of things for the first time, what are some of the common mistakes that you're seeing them make?
I think the common mistake we've seen for, 15 years in real estate plus is rosy expectations in their analysis. That's always the most common, especially early on. The old joke is tortured numbers will tell any tale, right? Yeah. So it's like, if you twist the numbers on the spreadsheet hard enough, they'll tell you whatever you want to see. But it takes the seasoned veterans. I most commonly see them with the most conservative estimates, the most what-if scenarios. So you might see a very conservative, a medium, and a high expectation projections. So I think early investors need to understand that most deals are very bad. Okay. So it's the expectation that, well, this deal can't be that bad. It's like most of them are actually. At the best point in the market, we were seeing about 2 out of every 100 deals was actually worth a second look at. Right now, we're seeing maybe 0.5%. of deals on our side meet our criteria maybe, and some of those are even, in the maybe not category. So it's a lot of underwriting. It takes a lot of effort, a lot of extra energy. So newer investors, if they want to do it on their own, I love that. It's the most entrepreneurial way to do real estate, but just know a lot of underwriting. Don't overshoot the expectations, and understand that it's not you, it's the market right now, right? There's deals that mostly don't make sense, and that's okay, because that's a market environment that, it's a cycle, right? And that's the part of the cycle we're in.
Yeah, I think, kind of reiterating what you're saying is, hey, look, you're going to be kissing a lot of frogs before you find that prince, just because it's not there. And that people are selling, trying to get out of these properties because it's not good. Because if they were great, like they're trying to make it out to be, then they wouldn't be getting out.
Absolutely. And the other side of kissing frogs is, I think people need to be upfront with brokers. And, there's a lot of upset brokers at what they're hearing from the buy side. So as buyers, I would say, don't be ashamed of the numbers you run. Feel free to send offers in and just preface it with the brokers. Hey, not sure if this is in your range of discussion, but this is what our underwriting told us. And get feedback, especially early on. Brokers are happy to help you get to their price, but just make sure you understand that they have a bias too, doing a deal.
How everybody's talking about AI right now. How is that playing a role in what you guys are doing?
AI is a great topic for investing because it has Wall Street. The repercussions are very obvious, right? It's like you can set up AI bots and, auto high frequency trading, really complex stuff. Real estate, it's a little more nuanced, to your point, Gary. I see AI in real estate really being an underwriting tool that can speed up underwriting of many complicated overlying trends and charts, and spit out things like confidence scores, spit out things like overlaying variables. Like, if you look, for instance, just to give you an exact example, there's complexity when you get into the data science of, well, what's the crime rate in the area? What's the trend upward and downward of the crime rate? What's the population density? Well, is that increasing in population? Well, what's the score and the ratio of success of population density today versus what it will be in 5 years? So there's things that are these drivers of markets that everybody can create. Humans can create what those scores might look like and the values of markets. AI, I think, is going to be a lot more accurate over time. Early in this process, which is where we're at today, I look at AI as a backup tool, saying, hey, these are our assumptions. This would be our rating of this deal. What's the AI projection look like? And compare those two. Later on, I think it will be more of a human checking the AI's numbers than the AI checking the human's numbers, which it is today.
Nic, I think you just brought up a lot of points about the crime and all of this other stuff that most people, when they're going in, they're just looking at the number side of it and just, okay, do these numbers figure and stuff like that, where there is so much more that is there that you have to look at. I mean, what other developments are going up around you? What, road expansion and different things like that you have to look into when you're looking at investing in real estate and commercial real estate. What are some of the other pieces like that that people need to think about besides just the flat numbers?
I think there's the science behind it, where you can drill down on the numbers and look into exactly what you believe the drivers are and where things will go in the future. The two biggest that are the softer side of real estate, some things like that you can quantify to some degree, but another part is just going to be the human experience of the deal. It's going to be why someone's selling a property and understanding the story behind that. Oftentimes it's, we call them the 3Ds: death, disease, divorce. All tragic, all very sad. That said, that's an obvious example of, well, it's not the deal that's the problem or the property that's the problem. It's the owner's situation that's the problem. Or there's functional obsolescence of the building, aka it's going to be a lot of money out of pocket for the buyer. Those are things to scratch your head at a bigger level, right? Those are things that are a little bit harder to quantify. You might, need to get into things like appraisal metrics for, things that are above what the average investor is really interested in doing. The other side, if you're investing with people, like maybe several friends get together and invest, maybe they invest with a syndicator, a professional investor, or they even want to invest on their own with a partner, it's evaluating who's doing the work, right? So that's property managers, the professional investor. That is, in our industry, it's called asset management. If you buy into the best opportunity, below market pricing, all the upside in the world, perfect market trends, if someone can't execute the game plan, that even if it's as obvious as it could be, if someone doesn't execute, you will lose. So that's the softer side of real estate, is at some point you have to evaluate team and who's boots on the ground and who's doing the work to get the numbers that you should achieve or the highest best return.
So Nic, we could go on for hours, I'm sure. Again, if they're trying to get into this, they're not thinking about wanting to invest in somewhere besides just the market. This is a great alternative to do that. But again, you got to think about all the right things. And I mean, you guys had years of experience with this. What do you see is the future for Saint Investments?
So Saint Investment Group, where we're at today, we're focusing on fixed income because we have a large group of investors, very sophisticated, typically higher net worth than the average investor typically. So what we saw was our investors aging quite a bit. Many are in the boomer generation.
Right.
What they were looking for was not 5-year deals, 7-year deals, 10-year deals. What they wanted something was more flexible, but also beating the market as far as returns, whatever market you want to peg that to. So they wanted something that was a 10 to 20-year play that they didn't have to check on monthly. They didn't have to reallocate, rebudget, et cetera. So that's why I like mortgages for the next decade plus on the income side. So if you were to say, Nic, what's your number one bet on the income side of the equation? I'd say without a doubt, I think U.S. single family mortgages will have the most impact on a decade plus and are the most rock solid. As far as somebody looking for more upside potential, absolutely. I think that it's analyzing what the investor needs on their side. If they are growth minded, I think they will see more opportunities in the next 18 months that come available than we've seen in the last decade that are really worth doing. So again, my bet is very heavily on industrial real estate. I think that has the biggest upside with the US market and the changes we're seeing. To me, the best opportunity is going to be in the niches of that. I think with manufacturing moving heavily to Mexico, as of right now, I think net all in, China is 2 to 3 times as expensive as Mexico. So all that to be said, so many people are moving to Mexico, so many big companies, and many even in the US. So to me, Southern United States industrial real estate investments have a huge opportunity as well. I like the California market. I think California has a lot of concerns at the state level, very few concerns on the industrial side on a long-term basis. I like Southern Texas industrial investment as well, especially manufacturing and warehousing. And so those are what absolutely I see as the shining stars moving forward. And I think the opportunities in the next 18 months that we will see more upside potential, both for growth and a lot of stability on the income side, if you choose where you're investing wisely.
Right. So Nic, we're running short on time here. What have I not asked you wish I had?
I think that's always the number one thing is just, I want to make sure people understand what the future of the different forecasts look like, what we're seeing at Saint. The biggest things we're seeing, higher inflation for 10 years plus. I think that's here to stay, which equals higher rates for 10 years plus. I think we'll do a return to norm in the U.S. economy of that 5 to 6% range. I see a soft landing today. I don't see a crash, which that might be for better or for worse. I think it's a longer but less pain, right? I think we'll see just a longer drawn out recession, jobs numbers slowly declining, hopefully inflation numbers slowly go the right way, but I'm not super hopeful we'll see that quickly. And also what I said is that I think now in the next 18 months is the best opportunity to be investing in the real estate world, especially for business owners that can get a tax benefit, especially for business owners that are trying to balance cash flow. Those are kind of my takeaways of the market today.
Great. Nic, I appreciate your time today. I think we've had a great talk. I think that for the listeners, anybody who's thinking about getting into some commercial real estate and other alternative investments like this, you've given them a lot to think about, and definitely, I think, have given them information so they can start asking some good questions.
Hey, great. I'm just happy to help we do all this day in and day out. This is our bread and butter. So
Right.
if anyone wanted more information or wanted to learn more about where our data comes from and the research that we do, we give it all away for free. So if they go to saintinvestment.com/resources, we have an economic tracker that tracks all data points that we find relevant. We put out our own reports, our own videos, our own updates on different things we're seeing. I hope I can help as many people as possible, especially the small business owners. I've been there. I'm still there. We feel for a lot of the navigation that community has to go through. So any support we can provide, we're always happy to do so.
Great. Nic, really appreciate your time.
Gary, great catching up with you here and look forward to seeing you again soon.
Great. Our guest was Nic DeAngelo, and he is the CEO and founder of Saint Investment Group. Thank you, guys, and I'll see you next week.
49 faces looked to him in triumph. Over the last 12 months, they had each taken turns and promoted his business for a week at a time, driving over $987,342 in revenue. What if you had a network of 50 centers of influence who promoted your business every week for a year? Grab your copy of the #1 Amazon best-selling book, The Ultimate Guide to Growing Your Business with a Podcast, at 33% off the Amazon price by going to ultimatepodcastbook.com. Again, that website for 33% off the Amazon price is ultimatepodcastbook.com.